Welcome everyone back. So in this video, we're going to be going over mastering fair value gaps with order flow here at Price Action Labs. And so every single strategy that you've seen on the internet relies on buyers and sellers at key levels. And so we're going to be breaking down the infamous ICT fair value gap. So this video is going to be dedicated towards finding the right fair value gap, avoiding the wrong fair value gaps, and knowing how to trade the break and retest, which is basically using fair value gaps. So this whole video is going to be about a fair value gap. But before we go into fair value gaps, I want every trader to understand how I form an overall trade. This is going to be a trade breakdown from last Friday, right? So we're going to be going over how to use previous day highs and lows, right? So using a previous day high and a previous day low is very simple. When you see price taking out the previous day high, you go and target the previous day low, right? Or you trade away from that sweep, essentially back down to the previous day low. So using a previous day high is very simple. So this was now the Friday, so I believe this was Friday the 15th of August, right? So if we just kind of zoom in on this price action, what we can see here is this is now the New York session here. This is the London session. So we see the New York session sweep down. We saw an aggressive sell-off after the sell-off from London. So once we take out the previous day high, this is a signal that the markets are going to reverse. So when you're using liquidity, you only need to use previous day highs, right? So that's kind of how I initially frame out the trade. Then for me, if we just make a quick kind of understanding, right? So this was a sell-off that we're going to be going over. And what I want traders to understand is that there's four basic pillars that I use in my trading. I start with market structure. I use my dealing ranges, I understand premium and discount, and then I use my fair value gaps. So here we can see structure low and structure high. This is our market structure. This is what we use to determine the overall direction of the market. Now, once we understand that from here, what we're now looking at, if I just zoom out a little bit, what we want to understand is that we have our 50% here. This is the equilibrium. And so the dealing range essentially gives us the equilibrium. So this shows us where we want to be buying and selling. So we took a trade from here and we want to sell back down into the discount. So we're looking to sell high, right? There's a saying of buy low and sell high. You can avoid 90% of your losses or 90% of your psychological problems if you only focused on dealing ranges, selling in the premium and buying in the discount. Now, how do we use fair value gaps? So this is going to be the meat of the video. So notice how we have a structural high over here. We've taken out the previous day high. We're in a premium. So we're in this premium range. We're going to be understanding how to use fair value gaps. And so the beauty of this strategy, and the reason I call it a triple X model, is because it relies on three things, hence the triple. So you need to know where to trade from, what to look for, and why you're looking for it. Now, if you think about it logically, every single trader approaches the charts with some kind of a key level, right? A key level is just a generic way of saying it could be a fair value gap, an order block, a breaker block, a support, a resistance, a supply or demand, and I just call it a key level. It's somewhere on the charts where we're interested in the price action. Sometimes I call it a POI, right? A point of interest, but it's an area on the charts that we are interested in looking in. And so I'm a big believer that psychology is heavily overrated, and every single psychological problem can be fixed with a technical piece of knowledge. So if you simply waited for a break of a 15-minute fair value gap and you targeted the next fair value gap, you would be profitable, right? So if you're struggling with greed, just target the next 15-minute fair value gap, right? Cap your risk reward at 1, 2, maybe 3R max. If you're a trader who struggles with finding entries, only enter when you see a 15-minute POI. So this is what I call a 15-minute POI. And the way that I mark this out, if we kind of zoom into it, is we can see here, this is the 15-minute fair value gap just over here. And I mark out the candle before the fair value gap. So my key level is essentially this region here. If we break above, we look for a buy. If we break below, we look for a sell. So often simplification leads to more profits, easier trading, enjoyable trading, and less psychological mess. So that's kind of where we're going. So using 15-minute fair value gaps is essentially a cheat code. Now on the lower time frames, we're looking for a break and retest. And that's how you use 15-minute fair value gaps, right? Everything comes down to a simple break and retest. And now we're going to be going over the lower time frame. So a lower time frame entry model. So just to make this a little bit more interesting, so this was a trade I took on the 15th of August, right? 2025, of course. So we're just going to be breaking this trade down from that day, right? So how was I looking at the markets going into that particular day, right? So let's let's kind of break this down. So yeah, so here was the trade, right? So it's the same thing you see over here. So this was me, my pre-market game plan. So this was 14:47, so that's going to be 9:47 Eastern. So what we're looking for here, very simple, is we have our structural high over here, and notice how we have our structural high, and we're simply looking to sell from the premium back down to the discount, right? That's all we're looking to do. All right, I'm going to give a bit of a clearer screenshot. So what we're looking for here, if I just kind of break this down for traders, right, what we can see is we see the POI over here. I've not marked it in on this image. So here's our POI, right? Notice how price has taken out the Asian high and price hasn't taken out the Asian low, right? The Asian low has remained intact. So we're simply looking to trade from premium to discount, from one 15-minute fair value gap to the next. So this is a very simple way that you can frame all of your trades, right? One 15-minute fair value gap to the next. So this was kind of my pre-market game plan. So 5 minutes before the market, I was kind of looking at this. So this is 9:25 Eastern, and this was my entry. So my entry here on this day, so this trade was about 1 to 2.5, somewhere around there, 377 for the day. And at this trade, I exited before 10 a.m. Eastern, right? Or just after 10 a.m. Eastern, I think it was. So I took a sell from this key level, and here was the initial sell-off down here. My first entry was here, second entry was here before the sell-off. We're going to be going over how you can trade using 15-minute fair value gaps in a break and retest type of trading, right? So let's go back to our PowerPoint. So here we have the lower time frame entry model. So what we're looking for is we're looking for the level to hold, we're looking for it to break, then we're looking for a retest. Now you need to understand what's going on at each of the regions, right? So what's going on at region number 1? So region number 1, we see passive buyers here, right? So passive buyers in this region. So when you go to the order flow footprint charts, what you're going to see is you're going to see an absorption of sellers. So there are a ton of aggressive sellers over here, and the market actually initially goes higher, right? So when you see that, what it shows you that there's passive buyers sitting in this region, right? So notice how we go from blue shaded region to gray. So this is now the market open. So the first 5 minutes I never trade. I'm looking to see how the market behaves in the first 5, maybe 10 minutes. So this candle here was a 9:30 Eastern candle. So we see the market breaking below. So this is where you want to use delta and volume, and we're going to come on to that in this video, right? But just for argument's sake so far, when you see any stock or instrument, this is ES, the S&P 500, it applies to anything. When you see a stock or an instrument breaking below the level, you want to see a high conviction break. And what that means is you're looking for a conviction break with high volume. So what we saw over here is we saw passive buyers failing as the market drove lower. So the initial passive buyers passive buyers sitting over here were unsuccessful, and there were aggressive buyers here. Again, this is via the order flow footprint charts. You can see the aggressive buyers failing and those previous passive buyers also failing. So now we're looking for a retest. So we've had our break, we're looking for the retest, and now we're looking for the retest, right? So notice how we broke below, and now we're looking at multiple rejects. So 1, 2, and then ultimately 3. So you can enter at any one of these retests over here, right? That's all you're looking for. So we're looking for the zone to hold, we're looking for a break, and then a retest. So it's very much break and retest. So why do traders mess this up, right? So you need one 15-minute fair value gap. You need to be patient to wait for the entry, and you need to use order flow, right? So here's why ICT does not work alone, right? So the reason why I'm not a fan of trading ICT or any pattern of that matter is that ICT concepts don't work because you don't have any way of establishing what's going on over here. So this here could look like liquidity, could look like a trend line, this could look like an imbalance or a fair value gap. The market didn't fill the entire fair value gap, right? So we left somewhat of a fair value gap here, just here anyway. We did not fill the entire fair value gap. So you need to understand what was going on in the retest. So how does a retest actually work? So let's kind of break this down. So this is the order flow footprint charts, and I'm going to have a very succinct breakdown of how this works. So we're going to focus on sort of this candle over here to begin with. Actually, no, we're going to focus on this candle first. So what you can see at this level, so this blue box here represents the same key level over here. So remember, right at the start, we're looking at a 15-minute fair value gap. So this blue box, this gray box over here, that is represented here by the order flow. So why does an ICT work? So let's quickly break down what this candle represents. So this is the ATAS platform, right? ATAS. This is the ATAS platform. I recommend traders using it when they trade ICT or just about anything else. So when you approach the London or the New York session, what you want to understand is that there's two numbers inside of every candle. You have the bid on the left hand side and you have the ask on the right hand side. And so the bid on the left hand side represents the aggressive sellers, right? So it shows you at this price point there are X amount of aggressive sellers on the left hand side hitting the bid. Now the right hand side is the opposite. These represent aggressive buyers. So now from here you want to ask yourself what was essentially going on in this candle, right? So if we just take a look at the top, we see 0 for 18. So what does that mean? That means that there's no aggressive sellers at this price point. There's only aggressive buyers, okay? And then we see the market breaking lower. So just from an order flow perspective, what's going on is we see these aggressive buyers failing to drive price higher, driving price above this key level, right? This gray box over here, which was actually this gray box over here. So 15-minute fair value gap. So inside of the 15-minute fair value gap, we see aggressive buyers failing. Now, what does this final box over here mean, right? So this was kind of the third retest. So if you just take a look here, we had 1 retest, 2 retest, and then 3 retests before we headed lower. Now in each of these retests, you could have entered or you could have sized up. So we're focusing on the last retest, and we're going to kind of combine this with ICT concepts. So what does this mean? What does 0 for 126 mean? So that's the number right at the top. So 0 again is on the left hand side. That's the aggressive sellers, right? 126 is the aggressive buyers. And so what you need to know from this when you're reading footprint charts is that here there's a ton of aggressive buyers, way more aggressive buyers than there are aggressive sellers. And so when you see that and you see the market breaking below, what that means, and then this price action here is this price action here. So this very, very big red candle is this candle over here. But you need to know what was going on here upon the third retest. So 0 for 126 represents the fact that aggressive buyers have failed to break above this level. So when you're trading anything, be it a breaker, an I fair value gap, a fair value gap, a supply zone, a resistance, an OTE, even an EMA crossover, right? This could work for almost anything. If you understood that there was a 0 for 126, this would confirm your entries. So inconsistency comes from having inconsistent actions. The market rewards consistency, patience, and of course, long-term dedication. Now, one of the best ways you can master this kind of strategy is by actually understanding what's going on inside of your strategy. So if you're an ICT breaker trader, let's say you trade breakers. Right, I don't even know what a breaker is, but let's say you're trading some kind of a breaker, right? Some kind of a break and retest to a fair value gap. Again, this is a 15-minute fair value gap. So we're focusing heavily on fair value gaps, right? 0 for 126 represents the fact that your fair value gap is being supported by heavy passive sellers. So if anything, it's a resistance area. It's a supply area. I like using the word supply. There's more supply in this area than there is demand, right? Because the buyers themselves have failed on 3 occasions, and this being the biggest and most obvious one. So 0 for 126 was initially the place you wanted to be looking at for potential sells, and you could sell at a break below. So my entry came, so if I go back to the Discord, my second entry came just about here. So this was me going in with 2 more contracts on MES, and we went down all the way to here, right? So this is where you want to be sizing up in your trades after seeing a third retest of buyers that failed. So what you saw here was aggressive buyers failing. The fact that we broke below with the body shows you that you should be looking to enter short. You should be looking to sell. Now the 0 for 126 is extra confirmation because a 0 means that there's no aggressive sellers, which means that there's only there's no aggressive sellers, right? There's only aggressive buyers, which means passive sellers, there's sell limit orders resting over here. So all those aggressive buyers are absorbed by passive sellers, right? All the aggressive buyers were unsuccessful, and that's why the market went down. And that's why fair value gaps hold in the first place. And that's why this trade played out the way it did. So you're simply looking to target one 15-minute fair value gap to the next. So going from 1 to 2, right? And using this gives you the confirmation. And what you're essentially doing is you're trading from premium to discount. So this fair value gap down to this fair value gap. And that is basically how fair value gaps work themselves, right? So just going to pause at this video and just going to go through this one more time. So whether you're trading a breaker, an I fair value gap, a supply, a resistance, no matter what you're trading, you have to pair it with order flow if you want to make it successful.